Welcome to Topic 6, Statement of Cash Flows, Part 5. What we're going to have a look at in the Part 5 video is how do we interpret a statement of cash flows? So the terminology here, net cash inflow equals positive cash flow, which equals net cash provided from operating, investing and financing activities. So I did mention that in the previous video, but here we're just going to cover over some of these basics again. Net cash outflows equal a negative cash flow, which equals net cash used in operating, investing and financing activities. So if you have a quick look back to your practical example that you've just completed in the previous video, we have a look at operating activities. Operating activities showed a net cash inflow. In other words, net cash provided from operating activities. Our investing activities showed us with an overall net cash outflow, and we called that net cash used in investing activities. And then lastly, our financing activities showed a net cash inflow, and we call that net cash provided by by financing activities. With our operating activities, positive cash flow, because that's the reason that you're in business. Excuse my mental blank. So operating activities, so that's all about your receipts coming in from your customers, and that's also the bills that you're paying as well. So your rent, your insurance, your electricity, your phone. So that's all your day-to-day operations. So we know the accounts associated with it, your current assets, your current liabilities, your revenues, your expenses. So they all comprise day-to-day operations. So the reason you're in business, how are you performing? Okay, so a firm here would be concerned if you had a negative cash flow, because really what you want to show is that you've got more money, more cash coming in from your customers than what you're paying out, say, to your suppliers and utility providers. The only time that you'd probably be, that you would accept having a negative cash flow here in your operating activities is if you were a commencing business. So you're a startup. Because generally when you're starting up and you're new, you're going to have a lot of expenses while you get on your feet. And you've still got to build a client base. You've still got to get your revenues flowing through into your business. If we have a look at investing activities now. So here, you would have a positive cash flow if you're selling old non-current assets and you didn't buy anything new. All right, so you're selling your old assets, so hence the cash would be flowing in through to you. Here you would have a negative cash flow if you're, say, replacing your old non-current assets and, or say you're expanding your business as well. All right, so you're purchasing things, you're spending money to grow, okay, or say to replace some outdated assets. And then with your financing activities, so positive cash flow if you're increasing your funding. So if you borrowed money, say, from the bank. Okay, you borrow money from the bank, that could be an inflow, or if you've, say, issued some shares, so you're getting equity in, say, from some shareholders. Negative cash flows could be from if you're repaying debt. So you've previously borrowed money and you're paying it back. So it's going to represent that outflow, that negative in your financing activities, or alternatively, you'd be paying dividends to your shareholders. Okay, so you're paying dividends out. So again, it represents an outflow, would represent a negative in your financing activities. So warning signals. So with our cash flow statement, it can provide us with some warning signals. So we need to look for the following. We want to look at our cash received compared to the cash that we're paying. Are we paying out more cash than what we're actually receiving in? Because if we are paying out more than we're receiving and we're not, say, a startup company, then that can indicate that we've got some bigger problems happening here. If we have an operating outflow, that can also indicate we've got some problems, because that does indicate we're probably paying out more money than what's actually coming in through our customers. What is our cash from operations compared to our after-tax profit? Is our cash compared to after-tax profit a lot lower? Is it a lot higher? Okay, because remember, cash is critical to a business. So if you don't have much cash, chances are you're probably not going to be able to function for too much longer, because you're not going to be able to keep paying for things. And yes, you can buy things on credit, but at some point you've still got to pay those suppliers the cash. Okay. Also, we want to look at proceeds from share capital, investments and borrowings. So do we have more money, say, coming in through borrowings as opposed to proceeds from share capital? Because remember, when you borrow money from a bank, you have to pay interest on that as well. So that's going to impact on your operating activities with the interest that you'll be paying back to the bank, as well as the repayments that you're making to the bank in your financing activities. So where are they getting their money from? Okay, how are they funding their business? Is it through shares, or say, is it through debt? Have they also got some longer term investments in their investing activities as well to help generate some wealth and generate some money, get some cash coming into their business? If we have a decrease in cash on a continual basis, that's certainly not a positive thing. As I said, cash is critical. We need to have it and we need it to come into us regularly. We don't really want to see a decrease on a continual basis. That could potentially mean we've got some performance problems here. Or maybe there's certain policies or practices within the firm that we need to tweak or adjust or change altogether. So here, if we have a look at another cash flow statement, so as a decision maker, let's assess this cash flow statement. So you can see we've got cash flow from operating activities, the 4 headings in there: our cash receipts from customers, cash payments to suppliers and employees, our interest, and our income taxes. And we can see that our net cash for operating activities overall is a positive. Okay, so it's $8 million. Look down to your cash flows from investing activities. So we've just got the one item in here, the purchase of property, plant and equipment, $20,000 outflow. So they didn't sell anything, they don't have any income from investments in this regard. Cash flows from financing activities. So we've got some proceeds coming in here from issuing shares. We also have some proceeds coming in here from borrowings. Although what you can see though is that the amount coming in through borrowings is only a third of what they're getting in through share issues. So if anything, that would be considered a positive. And then they are also paying out some dividends as well. So the net cash provided by financing activities, we've got a positive in there, $5 million. Overall, they've got a net decrease in cash and cash equivalents. And you can see a lot of that's attributed back to the equipment that was purchased in those investing activities. Their cash at the beginning was $12 million. So their cash at the end becomes $5 million. And that's just taking that, the net decrease, so that negative $7 million, and add the $12 million onto that, and we get the $5 million overall. So looking at this statement a little bit more closely, operating activities. So what we can say is that more cash flowed into the business from operations than what was spent on operations. So that's a positive, that's a plus. Okay, we do want to see that. Investing activities, we can say that more cash was spent on investing than what was received from investing. So they purchased more non-current assets than what was received from, say, selling non-current assets. Financing activities, so more cash flowed into the business from financing than what was spent on financing. So they borrowed more funds long-term than what was repaid on long-term funds. Okay, but what you can also say, as I mentioned before, is they are also getting in funding through equity holders as well from those share issues. So it's not like all of their funding is coming in from that debt source. So to summarise topic 6 cash flow statements for you, a statement of cash flows does enable our decision makers to evaluate an entity's ability to generate positive cash flows in the future, also pay dividends and also finance their growth. It provides a summary of cash and the types of cash that's flowing into and out of the entity. And lastly, a particular format of the cash flow statement is required. So with inflows and outflows being categorised as operating, investing and financing, as you've seen. So it's very different from our other financial statements. And what you'll find with cash flow statements really is that the knowledge that you've gained from the first 5 topics in this course is really going to help your understanding with cash flow statements. So cash flow statements, it's why we put it in topic 6 right at the back end of the financial accounting component of this course, is because it's like a big culmination of everything that you've been covering up to this point. So really you need topic 1 to then go into topic 2, to then go to 3, to 4, to 5, and then you're here in number 6. So it all leads up to this point. So you need your transaction analysis. You need to be able to classify your accounts. That is all going to help you to understand, well, how do I put this cash flow statement together? Because it includes a little bit of everything within it. So that concludes topic 6, cash flows. I hope you've enjoyed it.